Ethics and Trust introduces the importance of ethical behavior, professionalism, and trust within the investment profession as emphasized in the program. Financial markets function effectively only when investors trust that market participants act with integrity, fairness, and competence. Ethics refers to principles of conduct that guide behavior beyond mere legal compliance, while trust represents confidence that professionals will act responsibly and in the best interests of clients and society. Ethical failures can severely damage investor confidence, disrupt financial markets, and weaken economic stability. Consequently, the investment profession places strong emphasis on ethical standards to promote transparency, accountability, and long-term market integrity. The topic explains that professional ethics differ from legal requirements because ethical conduct often demands higher standards than simple compliance with laws or regulations. Laws establish minimum acceptable behavior enforced by governments, whereas ethical standards require professionals to exercise judgment, fairness, and fiduciary responsibility even when legal guidance may be limited or ambiguous. Ethical investment professionals must balance the interests of clients, employers, colleagues, and broader society while maintaining integrity and objectivity. Situations frequently arise where actions may be technically legal but ethically questionable. The program therefore emphasizes that professionalism requires individuals to consider both the immediate and long-term consequences of their decisions on market participants and public trust. Trust is identified as a foundational element of the investment industry because investors delegate substantial financial responsibility to investment professionals. Clients rely on portfolio managers, analysts, advisors, and financial institutions to safeguard assets, provide accurate information, and make prudent decisions. Trust reduces transaction costs and promotes efficient capital allocation because market participants are more willing to engage in investment activities when they believe others will act honestly. Ethical misconduct such as fraud, insider trading, market manipulation, or misrepresentation can rapidly erode public confidence. Historical financial scandals have demonstrated that widespread ethical failures may damage not only individual firms but also the credibility and stability of the broader financial system. The topic also examines factors that influence ethical decision-making. Ethical behavior is affected not only by personal values but also by situational influences such as compensation incentives, workplace culture, peer pressure, and organizational leadership. Research suggests that external pressures and environmental factors may contribute significantly to unethical conduct even among otherwise ethical individuals. Conflicts of interest, short-term performance pressures, and financial rewards can distort judgment and encourage inappropriate behavior. Consequently, firms must establish strong ethical cultures, governance systems, and compliance structures that promote integrity and discourage misconduct. Ethical leadership and accountability are essential for maintaining professional standards throughout financial organizations and investment institutions. The program emphasizes the value of ethical decision-making frameworks in guiding professional conduct. Effective ethical frameworks encourage investment professionals to identify stakeholders, evaluate conflicts of interest, consider alternative actions, and assess both intended and unintended consequences of decisions. Ethical analysis involves balancing competing interests while remaining consistent with professional standards and fiduciary duties. Such frameworks improve decision quality by encouraging broader consideration of long-term outcomes rather than focusing solely on short-term financial gain. Ethical decision-making therefore supports sustainable business practices, strengthens client relationships, and contributes to the credibility and efficiency of global financial markets over time. Overall, topic demonstrates that ethics and trust are essential foundations of the investment profession and global financial system. Ethical conduct promotes transparency, fairness, accountability, and investor confidence, while trust facilitates efficient market functioning and long-term capital formation. Investment professionals must often navigate complex situations where legal requirements alone are insufficient to ensure proper conduct. Strong ethical principles, professional standards, organizational culture, and decision-making frameworks help guide behavior and reduce the likelihood of misconduct. For CFA candidates, understanding ethics and trust is particularly important because professional integrity is considered as essential as technical competence within investment management, financial analysis, and fiduciary responsibility.